If you observe carefully what's happening in the financial markets right now, you'll notice something deeply concerning. While most retirees are watching their account balances and feeling relatively secure because the numbers haven't changed much, the actual purchasing power of those savings is being systematically destroyed. This isn't speculation, this is mathematics. And if you're over 50 with money in traditional savings vehicles, what I'm about to share could be the difference between a comfortable retirement and a financial crisis that unfolds in slow motion over the next decade. The reason most people don't see this coming is simple. Inflation doesn't announce itself with a market crash. It doesn't trigger emergency news alerts. It erodes wealth quietly, consistently, like rust on metal. By the time you notice the damage, years of purchasing power have already vanished. I've spent over 40 years studying economic cycles, managing one of the world's largest hedge funds, and I can tell you with absolute certainty, we are entering an inflationary period that will reshape retirement in America. The question isn't whether this will happen. The question is whether you'll be prepared when it does. This isn't a prediction. It's a logical consequence of decisions that have already been made. When you understand incentives, you understand behavior. And right now, every incentive in the financial system points toward sustained inflation. The U.S. government carries $38 trillion in debt. The Federal Reserve expanded the money supply by over $4 trillion in just 2 years. Real interest rates, when adjusted for actual inflation, have been negative for extended periods. These aren't random data points. They're the foundation of an inflationary environment that will persist far longer than most economists publicly acknowledge. Here's what most people fundamentally misunderstand about inflation. They think it's about rising prices. It's not. Inflation is about the devaluation of currency. It's about your dollars losing the ability to command goods and services. Think of it like a seesaw. On one side, you have the supply of money. On the other side, you have the supply of goods and services. When governments print massive amounts of money, but the production of real goods doesn't increase proportionally, the seesaw tips. Each dollar becomes worth less because there are more dollars chasing the same amount of stuff. Right now, we're seeing several enormous pressures building simultaneously. The federal government is running deficits exceeding $1.7 trillion annually. Social Security and Medicare obligations are accelerating as baby boomers retire, with over 10,000 Americans turning 65 every single day. The political will to cut spending doesn't exist on either side of the aisle. Meanwhile, the Federal Reserve faces an impossible choice: raise interest rates high enough to truly crush inflation and trigger a devastating recession, or keep rates relatively low and allow inflation to persist. They've shown us repeatedly which option they'll choose. They'll tolerate inflation because the alternative, a deflationary collapse with $38 trillion in debt, would be catastrophic for the entire system. History is an excellent teacher if you're willing to learn from it. We've seen this pattern before, and the outcomes are remarkably consistent. In 1971, President Nixon severed the dollar's link to gold. This wasn't a crisis moment, it was a policy decision. But it fundamentally changed the nature of the US dollar, from a claim on a fixed amount of gold to a purely faith-based currency. What followed was the inflation of the 1970s. From 1971 to 1981, the dollar lost approximately 60% of its purchasing power. A retiree who thought they had $100,000 in savings in 1971 discovered by 1981 that their money could only buy what $40,000 used to purchase. Their account balance hadn't changed, but their lifestyle had been cut in half. The Weimar Germany hyperinflation of the 1920s provides an extreme example, but the mechanism is identical. The German government, saddled with unpayable war debts, printed money to meet obligations. People who had saved diligently in German marks watched their life savings become worthless. There are photographs of people using stacks of currency to wallpaper their homes because the paper was worth more than the money printed on it. Now, I'm not suggesting the United States will experience Weimar-level hyperinflation, but the principle is exactly the same. When governments have debts they cannot pay through taxation alone, they inflate the currency. It's the path of least political resistance. More recently, from 2020 to 2024, we witnessed the consequences of unprecedented monetary expansion. The money supply exploded, supply chains disrupted, and inflation, which the Federal Reserve initially called transitory, proved to be persistent and painful. Grocery prices surged 25 to 30% in just 3 years. Energy costs spiked. Housing became unaffordable for millions. Retirees on fixed incomes discovered that their carefully planned budgets no longer worked. The $4,000 monthly budget that seemed comfortable in 2019 couldn't cover the same lifestyle in 2023. To understand what's happening to your retirement savings, you need to understand three fundamental principles. First, there's the principle of monetary debasement. When a government increases the money supply faster than economic growth, each unit of currency loses value. This isn't controversial economics, it's arithmetic. If there are 10% more dollars in the system, but only 2% more goods and services, prices rise by roughly 8%. Your savings, unless they're growing at least 8%, are shrinking in real terms. Think of it like a pizza. Imagine you own one slice of an 8-slice pizza, which represents 12.5% of the whole pizza. Now imagine someone cuts the same pizza into 16 slices, and you still own just one slice. You haven't lost your slice, but you now own only 6.25% of the pizza. The pizza didn't get bigger, it just got divided into more pieces. That's exactly what happens to your dollars when the money supply expands. Your account balance stays the same, but each dollar represents a smaller slice of the economic pizza. The second principle is the time value compression effect. Most retirees think in terms of account balances, not purchasing power. They see $500,000 in their 401k and feel secure. But security isn't about the number in your account. It's about what that number can buy over time. In a 3% inflation environment, that $500,000 loses about 26% of its purchasing power over 10 years. At 5% inflation, it loses 39%. At 7% inflation, it loses 52%. This means that a retiree with $500,000 today could effectively have the purchasing power equivalent of just $240,000 a decade from now, even if their account balance barely changes. The third principle is the fixed income trap. Most retirement advice focuses on shifting to bonds and fixed income securities as you age. The logic seems sound: reduce volatility, ensure steady income. But in an inflationary environment, fixed income investments are wealth destruction machines. If you're earning 4% on a bond but inflation is running at 6%, you're losing 2% annually in real terms. You're paying for the privilege of lending your money. Over a 20-year retirement, this doesn't just reduce your wealth, it can eliminate it entirely. Let me tell you a story about two families I observed through the 1970s inflation period. This isn't made up, it's the typical pattern I witnessed repeatedly. The first family, the Johnsons, were conservative savers. In 1971, they retired with $200,000, which was substantial wealth at the time. They put their money in treasury bonds and high-grade corporate bonds, earning what seemed like respectable 5 to 6% yields. They avoided stocks because they seemed risky. They wanted safety and predictable income. The second family, the Martins, also retired in 1971 with $200,000. But they took a different approach. They kept only 1 year of expenses in cash and bonds. They put 40% of their portfolio in stocks, particularly companies that produced essential goods, energy, and commodities. They put 15% in real estate investment trusts, and they put 10% in gold and precious metals, which seemed unusual at the time. Fast forward to 1981. The Johnsons still had roughly $200,000 in their accounts, maybe a bit more from interest. But a dollar in 1981 bought only 40% of what it purchased in 1971. Their $200,000 had the purchasing power of about $80,000 in 1971 dollars. They had to dramatically reduce their lifestyle. Vacations ended. Helping grandchildren with college became impossible. They were eating into principle just to maintain a modest standard of living. The Martins' portfolio told a different story. Their stocks, especially in energy and commodities, had increased substantially as inflation drove up revenues for these companies. Their real estate holdings appreciated with inflation and provided increasing rental income. Their gold position, which seemed eccentric in 1971 when gold was $35 per ounce, had grown tremendously as gold reached over $600 per ounce by 1980. Their total portfolio had grown to approximately $440,000. Adjusted for inflation, this represented real purchasing power of about $176,000 in 1971 dollars. They hadn't fully kept pace with inflation, but they'd preserved most of their wealth, while the Johnsons lost more than half of theirs. Now let's translate this to what really matters, how this affects you. If you're 55 years old today with $600,000 in retirement savings and you're planning to retire in the next 5 to 10 years, you need to understand what inflation will do to this money. Let's assume inflation averages 5% annually over the next decade. This is not extreme. It's actually modest compared to historical inflationary periods. At 5% annual inflation, your $600,000 will have the purchasing power of approximately $368,000 in today's dollars by the time you're 65. Think about what this means for daily life. Today, you might budget $5,000 per month for a comfortable retirement, which seems reasonable with $600,000 in savings. But in 10 years, maintaining the same lifestyle will require approximately $8,144 per month due to inflation. If you're withdrawing 4% annually from your portfolio, which is the traditional rule of thumb, you'll be taking out $24,000 per year or $2,000 per month. This won't come close to covering your needs. You'll be forced to withdraw principal at an accelerating rate, which means your money will run out far sooner than you planned. Let's look at specific impacts. Your grocery budget of $600 per month today becomes $977 per month in 10 years at 5% inflation. Your $200 monthly utility costs become $326. Your $1,500 monthly healthcare costs, which typically inflate faster than general inflation, could easily reach $2,750. Every single expense category expands, while your fixed income sources like Social Security, which adjust slowly and often inadequately, fail to keep pace. Here's the mathematical reality that most financial advisors won't clearly explain. If inflation averages 5% and your portfolio grows at 6%, you're only gaining 1% in real terms. If you're withdrawing 4% annually to live on, you're depleting your portfolio by 3% every year in real terms. Starting with $600,000, this trajectory means you run out of money in roughly 20 years. If you retire at 65, you're broke by 85. And that assumes everything goes according to plan, with no major market corrections, no unexpected medical expenses, no need to help family members. Based on these principles, here are practical guidelines for protecting your retirement savings in an inflationary environment. First, understand that cash and traditional bonds should represent only your short-term needs. I recommend keeping 12 to 18 months of expenses in cash and short-term bonds for immediate liquidity and emergencies. This gives you stability and prevents forced selling during market volatility. But anything beyond this emergency fund is slowly melting away. For the bulk of your portfolio, you need assets that can maintain or increase value during inflation. Consider an allocation structure like this: 35 to 40% in equities, specifically companies with pricing power, essential products, and strong cash flows. These include quality companies in energy, consumer staples, healthcare, and infrastructure. These businesses can often raise prices with inflation, protecting their real earnings. Another 20 to 25% in real estate exposure, either through REITs or direct property ownership if feasible. Real estate historically performs well during inflation because property values and rents tend to rise with general price levels. Allocate 15 to 20% to Treasury inflation-protected securities, or TIPS. These bonds adjust their principal value with inflation, providing direct protection. They won't make you wealthy, but they preserve purchasing power. Add 10 to 15% to commodities and precious metals. Gold, silver, and commodity-focused funds provide insurance against currency debasement. They often rise when inflation accelerates and confidence in fiat currency declines. Finally, keep 10 to 15% in international equities and currencies, providing diversification away from dollar-denominated assets. This isn't about getting rich. This is about not getting poor. The goal is to maintain your standard of living, to ensure that your decades of hard work and disciplined saving actually support you through retirement. Implement these changes gradually over 6 to 12 months. Don't panic and sell everything tomorrow, but also don't delay for years waiting for perfect clarity. The time to prepare for inflation is before it becomes obvious to everyone. Psychologically, prepare yourself for volatility. A portfolio designed to fight inflation will fluctuate more than a portfolio of bonds and cash. You'll see your account balance move up and down. This is normal and necessary. The alternative, watching your purchasing power steadily erode with no volatility in your account balance, is far more dangerous even though it feels safer in the short term. Common pitfalls to avoid. Don't chase yield in risky bonds or dividend stocks just because they offer high current income. High yields often signal high risk. Don't put all your inflation protection in one asset class, like loading up entirely on gold or entirely on real estate. Diversification matters. And don't ignore inflation just because it's not making headlines today. By the time inflation is the dominant news story, you're already late in adjusting your portfolio. Nothing in this constitutes specific financial advice. Each person has different circumstances, risk tolerance, time horizons, and financial goals. You should consult with qualified financial professionals who understand your complete situation before making major investment changes. This is educational information based on historical patterns and economic principles, not a recommendation for your specific situation. The choice is yours. But remember what's happening beneath the surface of calm markets. Central banks around the world are trapped between impossible alternatives. The U.S. government cannot reduce spending significantly without political upheaval. The Federal Reserve cannot raise rates high enough to crush inflation without causing economic devastation and making the national debt unsustainable. Given these constraints, the path of least resistance is persistent, elevated inflation. It's not what anyone wants, but it's what the incentive structure produces. Watch what major institutions are doing, not what they're saying. Central banks globally have been accumulating gold at the fastest pace in decades. Sovereign wealth funds are increasing commodity exposure. Pension funds are quietly shifting toward inflation-protected assets. These institutions understand what's coming because they employ hundreds of economists and analysts. They're positioning for the world as it is, not as we wish it to be. That's why this channel exists. To observe these signals before they become obvious, to translate complex economic forces into practical implications for your wealth, to provide the analysis that helps you make informed decisions about your financial future. The mainstream financial media won't tell you these things clearly because their business model depends on advertising from financial institutions selling products designed for a low-inflation world. If this analysis makes sense to you, if you can see the logical chain from massive government debt to monetary expansion to currency debasement to inflation, then subscribe to this channel. We'll continue tracking these developments, updating our analysis as conditions evolve, and providing the education you need to protect what you've spent decades building. Your retirement savings represent more than numbers in an account. They represent your independence, your security, your ability to live with dignity and help the people you care about. Inflation is a silent thief that will steal this future if you let it. But unlike a sudden market crash, inflation gives you time to prepare. You have the opportunity right now to adjust your strategy, to position your assets appropriately, to protect your purchasing power over the decades ahead. The question is whether you'll take that opportunity or whether you'll wait until the damage is already done. History shows us clearly which choice leads to preservation of wealth and which leads to its destruction. The principles haven't changed, the mechanisms are the same, and the choice, as always, is yours.